Right, how we all doing? It's been a little while since I posted a video, actually. It could be coming up on a month, I think. Yeah, it's long overdue. So for those of you that have never watched my videos before, right off the bat, you need to know that I ain't got a clue what I'm doing. I've got no financial background and I've got no financial qualifications. Basically, I'm just simply vlogging my educational journey towards hopefully becoming a successful investor. So this video is for informational purposes only and does not constitute any investment advice. Any opinions formed during this video are my own and not recommendations and are subject to change without notice. And please do your own due diligence and consult a licensed financial advisor before making any investment decisions. So there's that bit out of the way. I don't really know how to go about this video, to be honest. It's probably going to be a shorter one just to get back into it. Fortunately, my little boy was a little bit poorly, so that's why I've been away for a little bit. He's alright now, he's on the mend, so that's all good. But yeah, just looking at Crocs actually, because full disclosure, I am in Crocs, and I believe I got in around down here. 81 I think I paid, so starting to do alright actually. Norbert Lou, one of my early videos, Norbert Lou put me onto this. Shamelessly cloning Monish Barai. That's what he says to do. Norbert Lou, if you aren't aware, is one of the people that Joel Greenblatts talks about in his Columbia lectures that are on YouTube. That Charlie 479 was Norbert Lou. Norbert Lou runs a hedge fund called Punch Card Capital, and I noticed that he'd invested heavily in this when we were in this sort of longer term base around about here. So I thought, let's have a quick look into this and see what I can see. So I have got a thesis on this in the earlier videos, but like I said, none of this is financial advice because I don't know what I'm doing. It's literally just me vlogging my journey, and that's that. So obviously in the last videos we were going down through Screener, seeing what came up, and I don't know, maybe we continue to do that, or maybe we'll have it's been a while since I've looked at anything. Literally haven't looked at anything since the last video actually. So Rain Technologies, why do I know that? Yeah, maybe, I don't know, do we look at the screen or do we go on and go down through some insider buying in a minute? We got, what cluster buys have we got? BlackRock Coffee Bar, BRCB, never even heard of it. BRCB, Nasdaq, ooh. So I'm not going to be interested in this straight off the bat. It's just not got enough data. When did they purchase? $5, bought 73 million. Wow. Who's bought this? Who's bought it? COO. Sorry, I'll go over this crap again. It's been a while. There we go, advert gone. COO. Who's this? Synosia Group. Salt Lake City, Utah. Oh, $73 million worth. That was only 7 days ago as well. Let's it's not enough data for me, I'm not interested in that, but let's just see what there is, what you can garner from it. Was it BRCB? So negative simple free cash flow. Tangible book though, but nowhere near as much as market cap. Return on capital of just over 1.5%. That's a big fat no. I wonder what they see in it, but don't care. we got to start saying no fast. That was one of the things I was starting to struggle to do, but then I think I said in the last video that I've refined my screener, so hopefully it's picking up better quality stuff. So even though I want to say no faster, I'm struggling at the moment in that there's stuff generally about these criteria that I like, so I'll look into it a bit. But then I've still got to refine it, because I'd imagine Monish Prabai, he's the one that says you've got to say no immediately. Not immediately, but within the first few minutes, otherwise you're wasting your time. I'd imagine he's got some very stringent criteria, and he still managed to say no fast, so that's something I'm going to have to learn. GWRS, let's get this one up here. So for those of you who don't know, this is just a quick, what would you call it? Well, I call it a quick take spreadsheet, but it's basically, I want to know what the return on capital is, and that is Joel Greenblatts' return on capital, which is very similar to Lee Lu's return on capital. I want to know what the simple free cash flow multiple is. I want to know what the tangible book value is. So this, I guess, is a sort of downside protection spreadsheet. Is there any in the forms of assets? Is there any in the form of cash flows? Is the return on capital good enough that it could, historically, return to that? Anyway, GWRS, $7 a share, $2.50 tangible book. Now, I get the tangible book is not necessarily the value of it, because it's done on historical cost, so but I still will look at it and use it as a proxy for liquidation value. A proxy is not, if I go deeper, I will go into the balance sheet and try to come up with a liquidation value, but for the sake of being fast, I use tangible book as a proxy for it. So we've got no real downside protection on tangible book, because we're significantly below price. Simple free cash flow is severely negative the last 2 years, and return on capital is awful. 1.3% on EBIT. So this one's done on EBIT, and this one's using simple free cash flow. Was it historically any good? No. Very slim margins always. 2.4 free. And then simple free cash flow, it's barely had it, so owns, operates, manages regulated water, wastewater, Phoenix, Arizona. It ain't doing very well. They bought 217,000. It's not exactly a high number. You need to see. So my insider buying criteria that I like to see actually came from Roaring Kitty. In one of his videos, he said he's looking for around 300,000, I think. So doesn't really meet the criteria, but it's not bad. It's not bad insider buying, but I suppose between 3 people, it's not great either. Diebold Nixdorf, what the hell is that? So just, other thing quickly on my quick take spreadsheet is it will tell me what the company does. This all data comes from white sheets. You can see here. Tell you what we'll do, let's just close that down so I can get a better view of this. DBD. I would like to try and get in some stuff, really. So negative tangible book. Why is that? Billion in debt. Okay, but solid return on capital on simple free cash flow and EBIT, although it looks a lot higher this year, so something's happened there. What else have we got? We can determine straight from this. Operating income is up. Look. $8 a share though. No potential downside protection. People bank and shop worldwide. Okay. Simple free cash flow, 266 million. Trading at less than 1 times revenue, even with the debt calculated in. Was it DBD? Oh, well. It's probably already too pricey for me looking at that. How many times simple free cash flow is it trading for? 13 times. That's too high for me, really. This I don't like, and this is too high for me, really. I try to learn as much as I can from other investors. I've read a lot of stuff, I watched a lot of podcasts and all that, and people that have stumbled across my videos before, I'm probably repeating a lot of stuff, but people that haven't, Monish Paprice said you need to try and buy companies that will pay back within about 3 years. So I try to buy stuff on very low multiples, be true to that sort of investment strategy. You're not going to come across a lot. I'm sure Monish Paprice said if he finds 1 or 2 stocks a year, he's happy, and I am psychologically a value investor, and I subscribe to all the same things really that other value investors do. So unfortunately, my videos are probably not going to be finding a lot of stuff, but hopefully the stuff that we do find is going to be quite high quality. So, you know, swings and roundabouts really for people that want to try and get rich quick. This is not for you. I am trying to see whether or not I can beat the market. And we will see. At the moment, I'm not doing too badly actually in my investments. I think I am flat or just under on one, and I am 20 to 40% up on all the others maybe, so not doing too badly at the moment. But it's like, what am I, probably 8 months into my actual vloggable journey. Yeah, we'll see how it goes, but like I said, don't expect any big grand, oh yeah, we're going to find stuff, because I think the way that I am wired, the way that most value investors are wired, and you're not going to find a lot very often, but hopefully what you do find has true quality to it. So that is where I am at. We'll see what happens. One of the things I have been reading, I quite like Howard Marks as well. I know Warren Buffett said it, as soon as he sees anything on his desk from Howard Marks, it's the first thing he reads. I don't believe in the efficient market hypothesis, theory, whatever it is, but to an extent I do. I think I'm sort of in the Howard Marks book on that one, where he says that a market like the US is largely efficient, so it's a lot harder to find stuff in that. And I have noticed that if you actually have a look at a lot of investments for Monish Paprice, Lee Lu, Michael Burry and all that, they're not, some are rooted in the US, and that's because the data available is generally the best. I wish the UK would have a SEC type website where you could find everything, because in this country it's fucking annoying having to go to the investor relations pages and all that and try and decipher everything yourself, instead of having it all in one searchable database. I actually think it would be much better for our business in this country if we had that, but as far as I'm aware, we don't. I mean, please comment if I'm wrong, but because I'd love to find somewhere. But like I said, I've noticed that a lot of their investments as well are not always around the US stuff. In fact, I would say recently the majority of them aren't. So I am leaning more towards maybe making my screener tighter, more stringent on the criteria, and going global and having stuff to look at there, as opposed to just keeping it in the US, because I'm not finding an awful lot in the US at all. I will say all bar one of my investments are actually in the US, so it sort of sounds like a lie, but I am running out of stuff now. Once I found the stuff that I thought was investable, I'm running out of stuff now. So I will have a think about it. I run a lot of my thought processes and all that through AI. I use Grok and ChatGPT a lot, which is why they're up here. But what's going on? Yeah, I do wonder whether or not I should be making the criteria more stringent and going global, and hopefully I would find more stuff which may be better for the channel. We'll see. But yeah, where were we on this quick take spreadsheet? Why I'm not so interested. 13 times multiple is quite high. I don't actually know what the incorporates automate, digitize, and transform the way people bank. It operates through two segments: banking and retail. Company offers cash recyclers, intelligent deposit terminals, teller automation tools, kiosk technologies. Hang on then. What we'll do quickly. Explain DBD. What is it? Diebold Nixdorf. One of the good things I found from AI is we can do this. Explain DBD Diebold Nixdorf from an end-to-end perspective. What does the company do? And generally it will come back and tell you in layman's terms from who they sell to, and we'll see if I'm right. Acts as a strategic partner delivering integrated ecosystems that connect physical and digital channels, goes beyond selling hardware to provide full life cycle support, design, data-driven insights, key pillars. So, hardware systems, software, services, security. Works in practice. Explain it stupider. If I went to DBD, what would I be asking? Ooh. What would they supply? You own or run a bank. You say, I need ATMs that actually work well, look modern, don't break all the time. Or you can help us replace all our old cash. Can you help us? Actual ATMs, machines that can't recycle cash, teller software that runs on those machines, people who come fix the machines, full service contract. You own or run a supermarket, I need better checkout machines. So they do, okay, so they do quite a bit then. What they would supply. Bottom line, dumbest version, as an ATM self-checkout company you go to when you need physical machines, brains, someone to install them, someone to keep. They don't sell to normal people walking in off the street, they sell to big banks, big stores. So a bank, they basically say, help us. There you go, see? That makes it a lot more easier to understand, doesn't it? Basically, you can just keep asking Grok to dumb it down to your intelligence level. DBD, SEC DBD, what have we got here? Just have a look at the interactive data for now. Financial statement. Balance sheet, not that one, then this one here. 373 million in cash. Trade receivables, so what they're owed now of allowances, losses, so they're not expecting too many losses. Inventories. What do their inventories consist of? Okay, 293 million in property. There's a lot of goodwill. That could be where a lot of tangible assets. There you go, fucking hell. This is where it all is. I don't like goodwill and I don't like intangible assets. Generally, they're worth nothing, you know. Unless you're a really good company, goodwill's generally never worth anything. It's always written down. Not always, but you know, on the assumption that it will be. And intangible assets are, depending on the company, not potentially worth a lot. Coca-Cola's brand name is worth something, and you can't say that there's no value to that intangible asset, same as McDonald's and bloody Ferrari and all that sort of thing, you know. But they are outliers as opposed to the rule. So we've got, what have we got there? Almost 1.4 million goodwill and intangible assets, which is probably why it's negative. Tangible book value is negative, is what I'm trying to say. I'll tell you what I should do really is add book value into this, just so I can see the difference. I suppose it's a quick take, that's why I haven't got it. Have I got down here? Total assets. I haven't got total liabilities because I don't need it for the... This is all stuff I need for the return on capital calculation down there, which is explained there. That is the calculation for it, and there is a description in that as well. Yeah, alright, we're going to move on from that. I think, where were we on here, weren't we? Doing the quick take spreadsheet through the inside of buying. The problem is when this is up here, you can't see how large a position it was. I drag it off screen, you can't see it. It's a lose-lose, isn't it? ABG 2 million. Okay. Let's have a look at this. Drag it up here. Negative tangible book again. Goodwill and intangible assets there, 4 billion. It's 3 billion total in current liabilities alone. Return on capital's not bad though, very consistent. Well, I say consistent, it's actually dropped off quite a lot, hasn't it, post-COVID? Simple free cash flow though, generally positive, 600 million. So if we got enterprise value is quite high, massively high, look. Is it a total debt? I don't like this. I like a strong balance sheet, and I think I'm going down the route of the strong balance sheet has to be a must, which will knock me out. Sorry, I'm just having a drink. Will knock me out of quite a lot of investments, I think. You just read so much stuff from investors that have lasted for years and years and years, and they all say the balance sheet needs to be spot on, you know. And generally, if you've got a negative tangible book value, your balance sheet ain't great. Sorry for drinking. We're recording this in the middle of a fucking heat wave in the UK. It's brutally hot at the moment. I'm at work during the day. You have to wear overalls as well. So it's been 32 degrees and muggy. I know a lot of people say 32 degrees ain't hot, but in this country it's so muggy with it. And then you got to wear overalls, and it's bloody huge engines running everywhere. My work is so hot at the moment. Got to get home and use that time to rehydrate. Anyway, back to the investing shit. 14 times free cash flow, 9 times EBIT. Probably going to say no on this as well. Like, the return on capital's not bad, is it? Let's just see what the chart looks like. I suppose this is the only thing by doing it through this, and for some reason I've lost pointing at the screen as if pointing at the screen as if I got a webcam up yet. But I do intend to get one, I think, because I've read a lot of stuff to say that helps with the views as well when people can put a face to something. Not that I'm overly keen about putting my face all over the internet, especially when I don't know what I'm doing, but, you know, you used to be able to hover over these and it would show you a chart, and now, for some reason, that fucking ability's gone, and I don't know why, and I don't know how to get it back. But that is the only downside in seeing whether or not things are potentially okay. So there's been some pretty decent upside. Although if we look at this from a technical perspective, because believe it or not, technical analysis is where I actually started my journey. Thinking that you could do it that way. What a fucking idiot I was then. Not keen on this. This is probably coming a lot lower technically. Broken through, it's retesting this lower level now. And if she comes down again, next logical position is around about here. Maybe even lower. Maybe even lower. That'd be a bit like catching a falling knife, this one. ABG, let's have a look. I said, problem is these videos potentially could just be boring, because I'm just going to say no to a lot of stuff, unfortunately. PP&E 3 billion, so let's fuck this one off, start a new one. Lane, was it ABG? ABG, Asbury, Automotive, to me. Business model, revenue, sectors, and geography. See what it comes back as. Fortune 500 company, one of the largest franchise automotive retailers in the United States, headquartered in Duluth, Georgia, operates a network of dealerships offering a full range of automotive products and services. Okay, business model, franchise dealership group that are partners with original equipment manufacturers to sell their brands locally. Vehicle sales, new and used vehicles, parts and services, digital omnichannel tools, platforms like ClickLane, online shopping. Expands via buying dealership groups and optimizes them. Model benefits from scale but remains tied to local execution. Revenue sectors, new vehicle sales 50 to 55%, revenue 25 to 30, parts and services 14, finance, gross profit shift, mix shifts heavily towards parts services and often 60 to 80% combined. F&I, what's that? What's F&I? Finance and insurance. Gross profit mix shifts heavily towards parts and services. Okay. So the majority of the profit is here, even though the majority of the revenue is here. In 2025, the company reported annual revenue of 18 billion. So it's basically all in America. All in the US of A. Should we pull this in or not? What's the quick take telling us? 14 times. What was it historically? Average 6 years, 20 times. So it's cheaper than it has been on average on simple free cash flow. It's only 6 times on market cap. It's got a hell of a lot of debt. Current maturities of long-term debt, 456 million. What was their simple free cash flow? 600 million, okay. So it's potentially covered, although they've got no cash. Long-term debt, 3 billion. Fucking hell, they got some debt this year. Payable notes. These, they're most floor plan notes. They appear to a lot of debt due this year. Floor plan notes. Trade and non-trade. Who equals? That's the wrong one. On top of their LT debt maturities. What are floor plans? Bloody hot in here. Inventory financing used almost exclusively by auto dealerships to purchase and hold vehicles on lots before selling. Lenders, banks, a line of credit dealership draws onto it to pay the manufacturer auction for the new vehicle. So is this like bloody pre-sale stuff? Each vehicle serves as collateral. When a dealership sells a vehicle, must promptly repay a specific loan amount tied to that car. So, floor plan notes trade financing from the vehicle manufacturers often has favourable terms in financing from third-party lenders not affiliated. Paying cash for hundreds of thousands of cars with type of massive capital. Floor plan lets dealerships operate with far less of their own cash, improving returns on equity, but it creates large reported liabilities that fluctuate with inventory levels. Okay, so it's a cost of doing business then. In which case, so is it a cost of sales? How would it appear on the income statement? Let's just read this bit. A normal large part of operations, they sit on top of current maturities, loans and debt. The floor plan itself rolls continuously rather than having a single maturity wall. Okay. No floor plan interest, not a cost of sales, reported as a separate financing expense below the operating income line. So total revenue of 4 billion. You've got gross profit of 700 million. Fucking hell, so it's all negative, is it? What's going on here? What are they saying? How can it be an interest expense? Floor plan interest expense 21 million. But in this quarter, where are we? 326 million. What I want to see then, this is where, oh, fucking hell. Fuck that up. You got to click across the screen to go back on a different thing. I'll find them. Another 10Q. There we go, interactive data. Let's have a look at 10K. Because they're saying floor plan notes liabilities are 2 billion. Right? So they're saying it's like an interest expense. Surely, logically, interest expense would be... That doesn't fucking add up, does it? But, hang on. Current floor plan liabilities are hundreds of millions. Yet, the interest expense in the income statement is much lower. If cost is found in the income statement, where is it when that doesn't add up? This is what I like about AI, is you can ask stupid stuff. Adds up once you consider how interest actually works. It shows the full amount owed. Yeah, I get that. Why not put what I'm trying to say across properly? Does capture the full cost of floor plan financing for the period. It's just the interest line, not a percentage of the entire principal every quarter. And you can tell I haven't done this for a while. My brain's not clicking into gear. It's also too hot though. Where does debt payment appear in the income statement? I don't know if it even does. Do not at all. I thought so. In the cash flow statement, it's been a while since I've done this. This is exactly why you shouldn't listen to me, because I have a few weeks out, my fucking brain goes to rot. But I haven't slept a lot, and it's very hot, as I've mentioned several times now. Right. So, let's just go back. Oh, fucking press the wrong thing again. Right, let's go back to the 10Q. Financial statements, balance sheet. So you have paid down some. Right, cash flow statement. Finance activities, floor plan notes. They did pay 2 billion. None of this adds up though, does it? Constantly having to borrow. They don't make enough to pay off their current floor plan notes. I don't think they do today. What are we saying? Income statement. Net income 187 million. No, they don't. They don't make enough to pay off their current floor plan notes. So every year they are borrowing to cover the No, it's not they don't make enough and have to borrow. Floor plan notes revolve and self-liquidating finance tied directly to inventory turnover. Here's the accurate picture. Okay, explain it to me. Buys a vehicle. This is what I mean. I'm vlogging my learning journey in the hope that other people, if I can become successful, other people will watch this and be able to learn too. So I'm going to look stupid a lot of the time. I'm okay with that because I want to learn, and hopefully other people have these questions and it helps them as well. So when we work at Asbury buys a vehicle new for manufacturer used at auction, draws on a floor plan line to pay for it. Liability increase. They sell the vehicle, receives cash, repays a specific floor plan loan tied to that VIN. Liability decreases. This cycle repeats constantly across thousands of vehicles. It's not like a term loan with a big bullet payment. So it's a revolver. Is that what they said? On a revolving self-liquidating finance facility, yeah. In their statement of cash flows, they report hundreds of millions in floor plan borrowings and similarly large repayments in the same periods. For example, one recent quarter, floor plan borrowings, non-trade. I think what I'm struggling with is how this lines out in the statements. Changes often appear in the operating activities because they're so closely tied to core inventory. So we've got net income of 187 million. Why the balance persists and fluctuate. Ongoing operation. They do generate enough cash from operations to support the business, servicing interest, funding capex, pay taxes. Ongoing operations require ongoing financing, higher sales volume, temporarily increases acquisitions, divestiture. In strong inventory turnover periods, net floor can even decrease. Bottom line, this is normal, healthy working capital management for any large auto retailer, not a sign of insufficient earnings. If inventory days supply rises sharply, casts along a rate spike, it can pressure cash interest, but Asbury actively manages to offsets, mixed trade, non-trade, and overall liquidity. So, explain how purchase would be handled in the financial statements. they've got what they have 223 million in quarterly. I think this might be one gap we can get hung up actually, as I'm forgetting that that's 3 quarters. That's the first, sorry, not 3 quarters, the first 3 months. They have 223 million in quarterly OCF. Divesting quite a lot then. What we say in capital expenditures, real estate, say about 50 million. Circa 50 million in capex. Financing section is big. Explain it simply. When HP buys a vehicle, inventory asset by the cost of the car. Inventory goes up, yeah, by the cost of the car. Floor plan notes payable, liability by the same amount. They borrow via the floor plan line to pay for it. No immediate cash outflow for the price, full purchase price. That's the point of the floor plan. Borrowing shows up as a positive number in the financing section, or sometimes adjusted and operating for trade floor plan. Nothing yet, no expense until the car is sold. While the car sits on the lot, small daily interest expense accrues on the floor plan loan, shows up on the income statement under other expense. This interest is a real cost, but relatively modest due to quick turnover and some manufacturer subsidies. So when they sell the vehicle, revenue goes up, the cost of sales, what they pay for the car, goes up. So the gross profit, selling price minus the dealership. Okay, they also earn a high margin finance. Cash comes in from the customer or their lender. They replay the floor plan loan for the specific car, shows as a negative number in the finance repayment. Net effect, the borrow and repay largely offset each other over time. So, 220 million finance large gross numbers because they're constantly borrowing new money and repaying old money. This can be hundreds of millions each way. The net floor plan change is usually much smaller. This is a normal revolver. Okay, so it does make more sense now. It's getting in there. Think of it like this, simple now. You run a big till store selling TVs, buy 100 TVs on store credit, you sell them to a customer, finance profit from selling TVs plus service plan salaries. ASB generates plenty of cash from operations to cover capex, interest, tax, dividends. Big finance lines mostly. So what needs to be closely monitored to make sure the financing section is focus on these key metric trends. Inventory turnover, yeah, I got that in my spreadsheet. Not the way I've pulled up the big spreadsheet today, but it is in my spreadsheet. Day sales of inventory, 45 to 60 days. Let's put it in and see. Let's see how this data ties up. What was it? ABG, right. Let's drag it in and see how it ties up with what they are saying. ABG. Oh, fucking hell, I've done annual. I don't use annual data, by the way. I use quarterly. Then I can look at it rolling over time. ABG, let's try again. The reason why I do that is because no matter what time I look at it, I can compare it with exactly the same time previously. Am I doing the right thing here? It's been so long since I've done this. Right. Cash flow statement, balance sheet, income statement, main metrics, tangible book value is negative though. The book value is growing every year, but I bet the goodwill's growing every year. Let's have a look. Goodwill and tangible assets. They've changed the business model around this area. Got to have done that. Working capital analysis. Day sales of inventory 50. Okay. 75 is quite high. 2019. What did the price do in 2019? It was way down here. There we go. COVID, that's the problem there. Right, anyway, back to what Crocs was saying. Slow turnover, higher average floor plan balances and interest expense. Floor plan interest expense trend. Compare quarterly floor plan interest expense, the gross profit revenue per vehicle sold. Watch for sharp rises. Total available liquidity, cash plus floor plan offsets plus. So recent figures, 927 million to 1.2 billion. Where are we getting this from? Ooh, close that ring. Where are they finding that fucking... I don't add up with any of that, what they're saying. End of 2025, Q1 2026. Floor plan offsets account, cash that reduces leverage ratios. Net versus gross changes in floor plan. Look at net floor plan change. Borrowing minus repayments rather than the huge gross numbers. Small net changes or reductions when inventory is well managed. Asbury often shows net decreases and modest changes alongside strong operating cash flow. Consistent positive operating cash flow to comfortably covered capex. Have they got dividends? Don't know, they got dividends, so I ain't got to worry about that. Maintained underweight, so JP Morgan believes that it's cheap. I mean, what the hell would the upside? You know, 30% upside is not enough for me anyway. So to be honest, we've wasted a lot of time on this, but it's still worth learning stuff. Gross profit mix, parts and services, current ratio, working capital trends, healthy financing for ABG looks like strong inventory turnover, ample liquidity, leverage and target range, and OCF that funds operations plus returns to shareholder without relying on ever increasing net debt. What is their fucking... Okay, so their share count is pretty consistent. It has gone up and come back down. That's something. Operating cash flow share up. Average 3 years 29 was 22. Simple free cash flow up. What's the margin? Simple free cash flow margin 3 years. I mean, that's come way down. Way down. Gross margin average 3 years, 17% is down. SG&A margin, pretty consistent. So they're looking after their costs. Operating margin down. It's a declining, I wouldn't say a declining company, but it's not doing as well as it was. Okay. Day sales are payable. Consistent over the last few years, consistent. Went through the roof in 2022. Day sales outstanding. So they get paid quite quick. Guess that's, I don't know. Big gross financing flows are normal for the revolving model as long as the above stay favourable. Monitor these in each quarter. Rising rate supply. Okay. Alright, well. Learned a little bit there, haven't we? I'm not interested in this. Net cash used in financing activity is a huge difference. So what's happened there? 100 and something million. 100 and something million. Difference there. So there's 175 million more coming in. There's 175 million. That's strange, they're exactly the same. So they borrowed it and paid it all back. Purchase of treasury stock. Okay. Learned a little bit there, haven't we? Not something that I'm bloody interested in though. Not interested in a fund. Dorchester Minerals. DMLP. So let's see what they're doing. Ooh. When did they attack Iran? Similar return actually to my PTAL one. I think my PTAL return's better than that actually. Historical highs, 25%, not enough in it for me. We'll run it through just in the quick take spreadsheet quickly, and then I'm going to call it a night. DMLP. Quick take spreadsheet. Consistent look, consistent simple free cash flow. But multiple 10, too high. 10 years to pay, almost 11 years to pay back on your investment. Well above the 3 years. The management price said you should be looking. He actually said you should be looking for hidden P's of 1. So I ain't a good enough investor to find them. The 10 is too high for me generally. Tangible book value is well below price, so you have downside protection, but not a lot. Return on capital's gone off a cliff compared to what it was. Producing natural gas and crude oil. Revenues have shrunk slightly year on year. Operating income's down. What was it trading at here? Because I got these. This problem is this is price. It's not EV to free cash flow. I don't know if I can get EV free cash flow. We got that. If we have, I should be putting them in. Enterprise value to EBIT ratio. I could use that, can I? And your EV to EBITDA, I don't really like that because it doesn't have maintenance capex in it. I could be running that, couldn't I? To EBIT, because then that will give me multiples in line with this. EV to EBIT 60 times. I didn't realise that was on there, to be honest. Quarterly. I don't want quarterly, do I want annual, really? I'll put fucking 2 in there now. I'll get rid of this. And hide. No, not hide. Collapse. How do I collapse? Come on. How do I do that then? Come on. That's pain. There you go. Because I can still get the number up there. So, historically, all around here, 10 times EV to EBIT, 8 times EV to EBIT, 14 times EV to EBIT. We are currently at 17 times. So it's, are we at 17 times? 15 I've got, but 20 on average. So it's double what it has been historically. Okay. Right. Maybe we'll come back to this one in the next video, but not overly keen on it, to be honest. We'll see. Doesn't meet the strict criteria that I'm going to have to keep myself to in order to find these investments and say no fast. because it's worth putting the time in to find good investments. It is. It can't not be. I'm a value investor. I believe in that thoroughly, you know. Anyway, thank you very much. Waffled on a lot this video. I'll get back into it, I promise you. Get my head back in the right space, and we'll crack through some more. Like I said, I'll see maybe tightening up the criteria and going global. Maybe I can choose. Yeah, I can. Can I choose individual one, select multiple? That's what I want to do. Because obviously I don't want to do markets where auditing and all that is shit, because you don't know that his data is correct. Maybe I will run through AI and say what are the most trustworthy stock markets from the data perspective, and we'll bang them into it, and we'll do a global one from now on. Maybe we'll see. Anyway, thank you very much. Please like and subscribe, even though this one was boring as fuck, and I will see you on the next one. Goodbye.